What happens if you invest $100 every month? Most people believe building wealth requires a high income, a lucky break, or a huge amount of money to get started. But the truth is much simpler. Wealth is usually built through consistency, patience, and time. Imagine investing just $100 every month. At first, that amount doesn't seem like much. It's the kind of money many people spend on takeout, streaming subscriptions, or a weekend shopping trip without thinking twice. Because the number feels small, many people never start investing at all. But the biggest mistake isn't investing too little. It's never investing at all. The first few months, building the habit. When you start investing $100 per month, the results are almost invisible. Your account grows slowly. There are no dramatic gains. No life-changing numbers. No overnight success stories. This is where most people lose interest. They expected excitement. Instead, they find patience. But something important is happening beneath the surface. You're building a habit. Every month you invest, you're proving to yourself that your future is worth prioritizing. You're learning to pay yourself first instead of spending every dollar that comes in. At this stage, the habit matters far more than the money. Year 1, discipline over results. After 1 year, your investment account may not look impressive. The gains are small. The progress feels slow. But you've achieved something far more valuable than a short-term return. You've developed discipline. You've learned that setting aside $100 each month doesn't destroy your lifestyle. Life continues normally, but now you're building a financial foundation at the same time. Most people quit because they don't see immediate results. Successful investors stay because they understand that wealth takes time. When the market falls, sooner or later, the market will decline. It always does. You might open your account and see your balance drop. Watching your investments lose value can be uncomfortable. This is the moment that separates investors from spectators. Many people panic and sell. Experienced investors do the opposite. They continue investing. Why? Because market declines allow them to buy quality investments at lower prices. The investors who stay calm during downturns are often the ones who benefit the most when the market eventually recovers. 5 years later, proof that it works. After 5 years of consistent investing, your account begins to tell a different story. The growth becomes more noticeable. For the first time, you can clearly see that your money is working for you. No lottery ticket. No risky gamble. No secret strategy. Just consistency. This is when many investors gain confidence because they finally see the results of years of patience. 10 years later, money starts working harder. By year 10, something powerful begins to happen. Your investments are no longer growing only because of your monthly contributions. The returns you've already earned begin generating additional returns. This is the beginning of true compound growth. Your money starts earning money. Then that money starts earning even more money. The process accelerates over time, creating a snowball effect that becomes larger every year. 20 years later, the power of compounding. After 2 decades, the numbers can become surprising. A large portion of your portfolio growth now comes from investment gains rather than your own contributions. This is where compounding becomes truly visible. Growth is no longer moving in a straight line. It begins to curve upward. Each year adds more wealth than the year before. The longer you stay invested, the more powerful this effect becomes. 30 years later, approaching financial freedom. By year 30, your portfolio may be generating significant annual growth on its own. At this point, your investments are doing much of the heavy lifting. You are no longer relying entirely on your paycheck to build wealth. Your assets have become productive. This is one of the key milestones on the path toward financial independence. 40 years later, the results speak for themselves. After 40 years of investing just $100 per month, the outcome can be extraordinary. What started as a small monthly contribution has the potential to grow into a substantial portfolio. The most incredible part is that much of the final balance comes not from the money you invested, but from decades of compound growth. Time did the heavy lifting. Patience created the opportunity. Consistency made it possible. The real lesson. This story isn't really about $100. It's about what happens when someone commits to a simple plan and follows it for decades. Most people spend their lives waiting for the perfect opportunity, a bigger paycheck, or the right moment to start. Successful investors understand something different. The best time to start investing is as soon as possible. Because in the world of investing, time is the most valuable asset you can own. Small investments made consistently can create life-changing results. Not because of luck, but because of discipline, patience, and the incredible power of compounding. How to grow your wealth even faster. Investing $100 per month is a great start, but there are ways to accelerate your results. First, increase your contribution whenever your income grows. If you receive a raise at work, consider investing a portion of that extra income instead of spending it all. Even increasing your monthly investment from $100 to $150 or $200 can dramatically increase your long-term wealth. Second, focus on low-cost index funds. Many successful investors prefer broad market funds because they provide diversification and historically strong long-term performance. Instead of trying to predict the next winning stock, you can own a piece of hundreds of companies at once. Third, reinvest your dividends. When dividends are automatically reinvested, they purchase additional shares, creating even more compound growth over time. Fourth, stay invested during market crashes. History has shown that every major market downturn has eventually been followed by recovery and growth. Investors who stay in the market often benefit the most from the rebound. Finally, remember that consistency beats perfection. You don't need to invest at the perfect time. You simply need to keep investing regularly and allow time to do the heavy lifting. Common mistakes to avoid. Many people start investing with excitement but make costly mistakes along the way. They panic when the market drops. They stop investing during difficult times. They chase hot stocks because of social media hype. They try to get rich overnight. The most successful investors usually do the opposite. They stay patient, stick to their plan, and think in decades instead of days. Final thoughts. Building wealth isn't about being lucky. It's about making smart decisions consistently over a long period of time. A small investment may seem insignificant today, but years from now it could become one of the most important financial decisions you ever make. The sooner you start, the more powerful compounding becomes. Your future self will thank you for every dollar you invest today. And remember, the goal isn't just to make money. The goal is to create financial freedom, give yourself more choices, and build a future where money works for you instead of you working for money. If you enjoyed this video and want more practical investing, personal finance, and wealth building strategies, make sure to subscribe to the channel, turn on notifications, and join us for the next video. Because every week, we're breaking down the money lessons that can help you build a stronger financial future.